Hello everybody, I hope you guys are all having a wonderful day. Happy late 4th of July. Today I'm going to be going over technical breakouts. So what breakouts are? Well, a breakout refers to when the price of an asset either rises above the resistance line or falls below the support line, which usually indicates a trend of movement either up, bullish, or down, bearish. So today I have for you guys some common, very much used and common breakout patterns that I'm going to show you guys today to help you guys see in your own charts these technical patterns. Now, if you're using a app like Robinhood where it doesn't really give you good charting, it just shows you the basic lines or basic candlesticks, you can still somehow use it, but I recommend using TradingView as a good charting source. So I have images to show you guys, and the first one I'm going to go over is, this is going to be a quick to the point video, by the way. That's how I do it. That's how I like to give you guys quick knowledge that will help you guys. So the first thing we're going to go over is the double top. The double top is very often a bearish pattern, and what this is when we have two tops around the same resistance that fall down to a support in the middle, aka the neckline. So as you can see in this image right on screen right now, as you can see, it tops twice and then falls back down most likely. Image on screen that shows you good place to stop and good entries and a good target because it is a bearish breakout. So as you can see, you want your stop loss a little high if you're going with the puts or if you're shorting the stock, and you want your target down low where you think it's gonna go. So what you aim for is for this double top to break down past the support, and that means it's going to go down, usually, most of the time. The second very common pattern I'm going to talk about, which is pretty well known, is the head and shoulders. So the head and shoulders usually is often like a double top. However, the left side usually peaks up, goes down, back up, back down, back up, and usually back down, because this is a bearish pattern. The images on screen can do a lot more simple explaining than I can. So this is, once again, like I said, a bearish pattern. Puts, shorts, whatever you want to do to make the best out of this technical analysis. So the third one I would like to go over and give you guys a brief little show is the rising wedge. And the reason it's called a wedge is because it makes the shape of a wedge, and usually these rising wedges are a sign of a bearish pattern. What it does is the candles or the waves will funnel into a wedge and break down most of the time. This is once again used for bearish. These are also reversal patterns, so these are looking for reversals, and this means the trend is going to be bearish. So another reversal pattern that is bullish, aka meaning calls or shares because it's going to go up, is your double bottom. This is just like the double top but reverse it. So it's gonna go down, up, down twice and shoot up. And on screen again, you can see a better look at this pattern and get a quick idea. This is all common knowledge and easy to see and easy to use, and you'll get familiar when you see this on charts. I'll show you a little bit more at the end of charts, like real examples. The second bullish pattern is going to be your inverse head and shoulders, which on screen you can see now. It is the same thing as your head and shoulders, but flip it around. See, you get the gist. It's pretty easy stuff, but it's not everybody knows it, because a lot of people look for explanations and other stuff on other resources besides trusting themselves. And lastly, another bullish pattern, take a guess, a falling wedge. Same thing as the third one I explained, but the opposite. So the falling wedge, once again, funnels down into a wedge, which you can draw with lines, which I will show you guys another video on how to technically analyze these stocks, but this is just going over the basic patterns for you guys. Those first 6, very common, very straight to the point, very easy to use. These next ones are going to be continuation patterns, and the first 3 I'm going to go over are bullish. First of all, we have the falling wedge, a lot like the falling wedge we just went over, in fact exactly similar, but this usually comes in the form of a raise, a up in the trend, and then falls down instead of a fall in the trend and going up. If that makes sense, you can see in the images if you compare. So it makes a wedge, and usually once it hits the bottom of the wedge, it's going to break out, most of the time up. The second, we have a bullish rectangle. So a bullish rectangle is when the stock funnels, aka trading sideways. It's going to trade sideways into a rectangle, and you can look for a breakout there. Usually it's gonna go up, and usually it's gonna, or it could go down. As you can see, as you can assume. I bet you think the next three are the opposite. Well, guess what? You're right. The next three are gonna be the opposite. But before we get to that, we have one more new one. We have the bullish pennant, and this is gonna make a flag. This can also be called a bull flag, if you ever heard that saying. This means a rise in stock, and it drops down and down and down, usually meaning it's gonna rise again. So the images on screen are a lot more helpful than I am when it comes to explaining this, because it's easier to see it, to learn, rather than to hear me say it. After the bull flag is what we like to call it, we have the rising wedge, which is the opposite of the falling wedge. So not much needed explanation here. Then we have the bearish rectangle, once again, opposite of the bullish rectangle. So the only difference is this might go down one more time. It's usually a 1, 2, 3 pattern on the candles. The next we have the bear flag. So the bear flag is when the stock goes down and it makes that flag, that wedge, that flag, similar to the bull flag, but quite the opposite. And the last three I'm gonna go over today are my favorite. These are my favorite ones to look at. These are going to be your bilateral patterns, meaning mostly triangles. So at first you have your ascending triangle. And these bilateral ones mean bilateral because they can truly go either way. I like to wait for a breakout and confirmation of breakout before I enter these. So the ascending triangle is going to have usually a straight top on the technical analysis and a ascending line on the bottom that creates a triangle. This could go either way, as you can see on screen, so wait for breakout to determine whether you want to go up or down. It's the safest way to go, and set your stop loss. Next, we have the descending triangle. Once again, the opposite. It's going down and creating a top line is now descending, bottom line is even triangle. And finally, one I like to look for the most, symmetrical triangle. This is going to make literally a triangle, your symmetrical triangle. It's exactly what you think it is and exactly what it looks on screen. So I'm going to show you some examples that you would see on the chart. First, we're going to show you the ascending triangle. As you can see here, you can see how it makes the bottom line ascending and the top even. And this is a candlestick pattern if you've never seen this before. It's what I use, red and green most of the time. Green means good volume and good price movement. Red means bad volume, bad price movement. So as you can see here, it created a triangle breakout and it broke up bullish, and you can see we set a stop loss at the lowest support, I guess lowest support for the breakout, to prevent that. So you can take a look here and see. Next, you can see real life example, descending triangle, top is descending, bottom is even. Straight to the point, I like it. Symmetrical triangle, look, it literally looks like a triangle. It creates a triangle. And this could either go usually up or down. You never really know with these that's why you wait for breakout. Or if you have a good hunch, take it. You never know. If you believe in the company, why not? So these are wedges, as you can see here. A wedge pattern creates a wedge, almost like a triangle, not completely a triangle because it does not tee off. It does not close out at the end. This is your double bottom, makes a W. The big W means double bottom. Means it's usually that's a bullish pattern, it's usually gonna go up, but you can see here on the chart, it's a lot easier to see. Next we have our double top, also very easy to see. Creates a double top of M, usually an M. Here's the head and shoulders. Creates literally like the shoulder, the head, and the shoulder, and that's usually a bearish pattern, meaning it's going to go down. I'd like to also throw in here, as you can see on the screen, a cup and handle. This is usually a bullish pattern and one that's often happening in a lot of stocks. It literally makes a cup and a handle and usually is bullish. So I know this was quick to the point. That's how I like it, but I hope you guys actually learned a lot because just reading these charts and seeing these images have taught me a lot. And I'd like to share them with you so you guys can see for your own. So leave a comment, leave a like. I'd gladly answer and help you guys in any way, shape, or form. If you did enjoy this straight to the point video, well, leave a like, subscribe, turn on post notifications. I plan on making a lot more. And like always, have a great day, guys.